Инкубаторът – сърцето на София Тех Парк. Домът на всяка нова компания, която иска да е не просто в крачка с новите технологии, но и на една крачка от тях. Да, на метри от инкубатора е лабораторният комплекс, със своите 11 високотехнологични лаборатории и последно поколение петаскейл суперкомпютър, един от 8-те в Европа. И всяка една от компаниите в инкубатора има под ръка цялата тази мощ на науката, учените и технологиите. Самият инкубатор зад мен предлага всичко, от което една компания или дори само един фрилансър би имал нужда. Прекрасно офис пространство, зали за срещи и конференции, средата, както и постоянния контакт с други будни умове, които също преследват своите мечти. Има дори и парк, в който можете на открито, сред природата, да разнообразите работния си ден. Но инкубатора не е само това, което може да се види и пипне. Стартиращите компании имат достъп до разнообразни акселераторски програми, както и до всички необходими съвети и помощ от екипа на София Тех Парк. Кой фонд би бил подходящ за вашия бизнес, коя програма е отворена за кандидатстване, как да направите колаборация с лабораторията, подходяща за вашия ресърч или прототип. Експертите на София Тех Парк са на разположение на всеки с опита и експертизата си. Тук в инкубатора творят компании с различен профил. От спорттек, каквато сме ние от Барин Спортс, през финтек, фултек и автомобилната индустрия. До стартиращи компании в IT сектора, създаващи така наречените дигитални двойници. Други създават тук съоръжения, задвижващи се от кинетичната енергия на децата. Част от нашата общност са и клъстерни организации, фонд и акселератори. Общото между тях е създаването на висока добавена стойност в сферата на технологиите и иновациите, както и подобряване на българската предприемаческа екосистема като цяло. В Growworking имаме възможност да общуваме, да споделяме повече, както и да работим или да си почиваме. Дава ни знания, опит, контакти и понякога приятелства. Най-вече среда. Growworking е споделеното работно пространство на София Тех Парк. Създадено специално за новатори, стартъп компании, фрилансъри, както и екипите на корпоративния бизнес, където заедно всички могат да работят в една наистина творческа среда. Дори могат да идват с децата си. Clubhouse е дигиталното студио на София Тех Парк, ядрото на инкубатора, където се зараждат иновативни идеи, концепции, партньорства и проекти. Clubhouse е домът на вече 14 клуба по интереси, които организират регулярни месечни видеоиздания, както и подкаст. Пространството е подходящо за различен формат онлайн и хибридни събития. Независимо дали развивате хай-тек джаджи, които подобряват спортните постижения и предпазват от травми, или пък искате да създадете новия Facebook, или може би вашата компания е бъдещия биоинженерен гигант на Европа, то едно е сигурно. Най-доброто място за старт на това приключение е София Тех Парк. Заповядайте, за да създаваме бъдещето заедно.
Здравейте, приятели и партньори! Последните 20 месеца бяха силно предизвикателство за всички дейности и бизнеси. Всъщност, за цялата ни цивилизация. През това време ние бяхме с вас, като бързо развивахме дигиталното си студио и подкрепяхме вашите събития, за да са още по-качествени и още по-близки до вашата аудитория. През месец септември бяхме класирани в топ 10 класацията на Международната асоциация на технологичните паркове за вдъхновяващо решение по време на криза. Сега ние ви предлагаме един надграден и подобрен Clubhouse, за да сте още по-впечатляващи във всички ваши дигитални и хибридни събития. Добре дошли отново! Очакваме ви!
Hello friends, my name is Jordan and I'm super happy to welcome you in our third episode of Between Two VCs. MV3 is videocast about the world of venture capital investing, startups, technology and innovation. In a series of episodes together with my partner Alex, we're going to unveil the building blocks and the secrets behind the venture capital world and also the world of technology and startups. In this episode, which we hope you're going to find very insightful and interesting, we're going to talk about the term sheet, a milestone that each founder wants to reach. Some very happy news from the ecosystem. Last week, Payhawk announced their Series B record-breaking $112 million round, and we would like to congratulate the entire Payhawk team and also our friends from 11 Ventures and Early Bird. Most probably, this fundraise started with a term sheet.
Hello, everyone. Indeed, very positive news from the Bulgarian ecosystem this week. Let's hope that is just the beginning of many announcements on so sizable fundraising rounds and exits. As Joran said, today's topic is going to focus on the last stage of this fundraising process, which is the term sheet. We talked to 3 founders who successfully raised multiple funding rounds, and we're gonna give you our take on the term sheet and the different items inside there. And just to make the conversation and discussion here with Jordan more lively, we're going to play a short game where I'm gonna take the role of a founder and Jordan will be in the shoes of a VC investor. Let's see what's gonna happen. We also, as you know, have 2 regular mini-series in between 2 VCs, a deep dive on a global topic of our interest, and this time we're gonna look at PayPal's intention to acquire Pinterest, and it did not happen in the end, but we're gonna see why. And we ask you each time on our LinkedIn page about a topic of your interest. So basically you vote in our quiz, and the most voted answer this time is single versus multiple founders. So we're gonna discuss this topic as well.
Yeah, so thanks for this introduction, Alex, as well. Let's get to the chase, the term sheet. What is the term sheet? This is a topic and a term that is used on a regular basis, and we kind of are in this process almost every week. Let's say the term sheet is the preliminary document that kind of outlines the main terms and conditions of an investment and regulates in a formal way the so-called marriage between 2 parties, in this case the VC on one side and also the startup on the other side. It is the foundation that we use to agree on fundamental principles of our relationship with the startup, both in economic terms and also operational terms. Its importance is paramount for the 2 parties at the early stage of development of a given company, and that is why my recommendation to founders is to allocate the proper time to the term sheet and kind of have their game plan prepared early on.
Yeah, correct. And I think it's time to see our guests for today's episode and see what they think about the most important items in the term sheet.
My name is Victor Francis. I'm an internet entrepreneur. I've been active in the startup ecosystem for the last 20 years. For startups, we're focused on Eastern Europe. We did an alternative telecom in Eastern Europe called Orbitel. It came out quite successful. And after year 2009, moved to India. Currently, we're also having an FTTH internet provider serving 650,000 households in 20 cities in India. Currently, it's the 3rd largest FTTH provider, which is basically a good achievement so far, and looking forward to reach 10 million subscribers. Now moving to the topic, which are the most important terms to look for in a term sheet? I think the most important thing to look in a term sheet is essentially make sure your long-term interests are aligned with the VC. Every VC has kind of strategy, kind of things that they like, things that they're looking for. So, so you want to make sure you understand their long-term strategy. You want to make sure your long-term interests are aligned. Now, some VCs are evergreen, which means they can stay indefinitely in your deal, and some have a deadline that they need to basically exit your investment at certain time frame. So you need to understand that time frame and make sure it is properly aligned with your vision of the company. That it is not going to harm you if you need to exit earlier than you expect. The other very important thing, which maybe I will reiterate later, is try to confirm how far the fund can support you, both as time frame and resources. This means, are they well connected? Can they help you in the next rounds? And do they have experts on board who can be useful to you?
I'm Cvetan Lažanski, and over the years I have managed, started, invested in different companies, have done 5 exits myself, 5 exits, and also have participated in acquisition of numerous companies over the last 20 years. Some of the more important items and terms to look for in a term sheet are, in general, there are 3 general categories, I think. They are governance related, which means who is on the board, what are the rights of the different people, general meeting, board, what are the veto rights, if there are any, of the investor, class of shares, what are the rights of the different classes of shares. So these are the governance related. Shareholder related, these are different terms that are related to how the shareholding is regulated, which means, are there any tag-along rights, drag-along rights, rights of first refusal, any options, or sometimes also if the founder is the manager, what are the mechanisms for remunerating employee stock option plan, these things. And I would say third term is price related, which is what is the price mechanism, how it is calculated, are there any compensation mechanisms, etc.
Hi guys, it's nice to be together virtually with you. My name is Evgeny Yordanov. I have more than 15 years of experience in different fields of the web, the so-called web, starting from development, design, marketing, e-commerce, consultancy, etc. Currently, I'm occupying the position of Chief Digital Officer and partner in one of the leading e-commerce SaaS companies in the world, and by extension, Europe, of course. The company is called CloudCard. Our company had the honor of being recognized as such by a slew of different potential investors. At this point in time, I can happily say that we've had the pleasure of picking NV3 as becoming one of our leading investors. Can I say all of it? Yeah, well, if I'm to pick just a couple of parts, the most important ones from my standpoint, of course, would be voting rights and anti-dilutive provisions. I guess most founders would go straight for things like the valuation or the investment amount. And don't get me wrong, those are of huge importance as well. But with the voting rights and anti-dilutive provisions, there can be some of the biggest pitfalls there.
Well, we've seen our guests and their initial thoughts on the term sheet process. Now you're done. We've seen and negotiated so many term sheets together with you and founders for these years that we've been in the industry. I think on one side there are many items a founder can be frustrated about, but just to make it more lively, I suggest that we play a game. I'm gonna take the founder seat and you're gonna be the investor and try to play out different situation. What do you think?
Yeah, that would be interesting. Let's play it out.
Okay, so I received the term sheet from you. I didn't discuss with my lawyers because that's gonna complicate a lot of things.
Sure.
But I see already at this stage that there are several items that are kind of, let's put it mildly, I don't like it. So let's start from this, which you call drag along right? So, and I read it as a obligation to sell 100% of my company at a future point of time. When you decide to do so, I have to sell my shares as well. I think it's kind of not fair and not aligning my interest in a way, because I probably have a different exit timing or different view on that.
Well, I think that the alignment is there, given that from the very beginning, when you were looking for financing and you decided to get venture capital financing, you knew that you're getting financing from funds that are closed-end funds, the so-called closed-end funds. This means that they get their shareholders invest in the funds, and the funds has a life cycle between 10 to 12 years. This means that within that time frame, each fund has to invest in a company, allow it time to develop, and then monetize their investment. If you knew that from the very beginning, and if you're comfortable with that, then you're okay to go and look for financing from a venture capital fund. But if you think that this is not your way, this is not your case, then my recommendation is to go look for other financing. And you should know as a founder from the very beginning, in advance, that this is the way the venture capital funds operate. They have a limited time within which they have to realize returns, and they have to distribute them to their investors. And that's how they operate. And this is the type of instrument that you have to be comfortable with, and you should know that in advance.
Oh, I mean, okay, but even so, I mean, there is so much level of negative control in this term sheet that you handed out to me that, I mean, really, it's not balanced in any way. There is a lockup clause, right? So I have to stay with the company for 3 or 4 years and do nothing else. You have to approve the business plan for, the growth of my company. You can disagree with the strategic decisions that I may take or may not take for, again, the growth of my company. In the end of the day, am I going to manage the company myself and with my team, or you're going to be in the driver's seat?
Well, at the end of the day, you are going to manage your company. You're going to manage your company. We have invested in the team, not so much because we are an early stage investor. We have invested in the team, and they are the most important asset of the company. And this means that you're going to run the company. But this doesn't mean that we're not going to have any say into the, setting the strategic course of the company or deciding some very important strategic decisions. The difference between investing on the stock market and also the venture capital investing is that we are an active investor. This means that we want to participate into the setting the strategic course of development of the company. We want to be involved into all these important topics that are going to decide the future of the company for the next 3 to 5 years. We have invested and we also want to get a board seat so that we're involved in these discussions. And this is the difference. As an active investor, we want to have some level of control. We want to make sure that the founders are on the right track. They are keeping focus on the path to reach their next milestone, and we are there to make sure that also the money is spent in the proper way. That's why we have all these clauses inside. As an active investor, we need to have them. Otherwise, we will not be able to kind of exercise this control. I'm not saying that sometimes this control can be very limiting. It depends on the VC. That's why my recommendation to the founders is to try to choose the best partner in terms of VC they can get. This means that this VC should share their vision, should share their mindset, and also should share their work ethic. This is very important. And also back to the sorry to interrupt here, but back to the topic about the lockup agreement.
Yeah.
Why do we implement such a clause? Because we want to make sure that the founders are 100% involved into the development of the company. We don't want you to see that you have a side hustle, that you allocate 50% of your time. This means that you are setting yourself for failure, and that's why we want the founders to be 100% committed to the company. This means that they have enough skin in the game, so they care. They go to bed with the idea how to kind of fulfill their dreams and their vision. They kind of wake up with this idea as well. That's why we want it in place and in writing.
Okay. I mean, I see and understand this point. You're an active investor. You're an active negotiator as well, because it seems that you're kind of taking everything on the table to your side of the table. I don't think it's balanced. First, you're putting so much pressure on the valuation. You'd like to achieve a lower valuation, as low as possible. Then you have so many other rights like liquidation preference, which is on top of the low valuation. You have anti-dilution clause. You have preferred dividend. I mean, it's so skewed towards one direction. All the benefits are skewed toward your side. I don't think it's balanced and it's fair.
Well, it's one point to look. It's one way to look at these things, but you have to understand where we are coming from and what's the logic behind all these clauses. The valuation, we always kind of try to strike a balance kind of price point between what the founders think their company is worth and what we think their company is worth. We also kind of take a scientific approach. We try to kind of see how the business plan is going to develop. We try to use different valuation models, but at the end of the day, in early stage investing, it's all about the vision and the team. And at this early point in time, we cannot evaluate how much they are worth. That's why we use certain benchmarks. We are comfortable to invest at higher valuation, but we want the founder to come with us with a justified valuation. We don't have anything against higher valuation here. But at the end of the day, our primary purpose is not only kind of to help these founders fulfill their dreams and their visions, but also our primary concern is to return capital, a multiple of the invested capital to our investors. And this is our primary concern. We are money managers, and this means that entering at the right point, the right price point is very important for us. You mentioned the other, kind of terms that we have about like anti-dilution, liquidation preference. On one side, it could be seen very, let's say, restrictive, but at the end of the day, this is risk capital. You cannot get the same financing from a bank, because if you go to a bank, you get a loan, you have to put a collateral. Which collateral it is going to cost you, and sometimes if things go south, this means that you can gonna lose this collateral.
So this is your sort of collateral here.
Well, it's not collateral, because if, for example, the company goes bankrupt, we lose all our money. We are putting the liquidation preference kind of to limit the downside if the things go bad, but they do not go totally out of control, and the company doesn't go bankrupt. For example, if we invest at a valuation of 3 million, we invest $1 million, and then the company sells for 2 million, then the first $1 million is going to be for us. And then the rest of the founders are going to distribute between themselves. And again, this kind of anti-dilution thing also and liquidation preference, they have to do with the stage of investment and the risk that we take. We want to have a commensurate, let's say, protections and benefits and rights commensurate to the risk that we're taking.
Yeah, I understand. It's kind of a tricky process to negotiate a term sheet in the end, or at least it seems to me.
Well, I think it's very tricky. It can be quite complex if you don't know what you're doing. That is why my recommendation to founders is to kind of not to jump into that emotionally whenever they see the term sheet. try to look at it from a holistic point of view, from a 360 degrees point of view, and try to understand what's the logic behind all the clauses. If you are a first-time founder, chances are that you don't have the experience that is necessary to go into such complex, let's say, negotiations. The party opposite of you, that is going to be the VC, is going to be much more experienced. That's why I have some recommendations that you can kind of follow whenever you are going into such a process. The first thing is get into the fundraising process, well prepared and well prepared. Just don't allow for the fundraising process to be very lengthy, because you don't want to reach a point of attrition. Just don't go with this scenario of raise or die, because this means that you're going to be limited, squeezed by time, and most probably than not, the venture capital fund is going to sense that, and then they're going to squeeze you and take advantage of that. So that's the first thing. The second thing is about the valuation that I mentioned before. Come prepared. Come with a justified valuation. Again, we don't have problem with high valuations, but we have a problem with valuations that you have taken from an internet page. You have heard that some company in Germany or in the States in the same field has raised, let's say, 100 million round, and they are doing the same thing, and you come with us and you want to get a similar valuation like them. This is not the case. They have a different setting, different market, different metrics, and you don't know, what the particular situation has been. Another kind of, a working tactic that I would recommend to people is to get the advice of a founder that has already done fundraising. They have gone through the learning curve. They know what the mistakes are. They know the pitfalls. They know what to look for, and they can give you invaluable advice. And yeah, these are the, let's say, three things that I would more or less recommend. Not recommend, just kind of working tactics. One thing probably I forgot as well is to look at the term sheet holistically. Don't take this piecemeal approach of negotiation clause by clause. Just look at the things, decide which are the most important for you, and then based on that, try to trade off between clauses that are not that important for you for clauses that are super important for you.
Yeah, but that's your view. Let's see what the view of our guests on this topic is.
I would say that if you have done already 1-2 deals, there are very few items that can surprise you. But if you are a first-time founder, then definitely some of the things that are there will be difficult for you to understand, in the sense how they develop over the long run. What are the implications? For example, what is the implication of right of first refusal, for example, or tag along, drag along? How is it going to work 3-5 years down the road? Also, how is it working with A round, B round, C round? What are the relationships? So if you're just starting, you wouldn't know. And my advice, of course, is to ask somebody who has been down the same road.
As I already alluded to, the voting rights and anti-dilutive provisions are usually the main culprits here. The one on the voting rights means that when creating the management board, if not done correctly, an investor may take charge and change company policies that differ from the founder's visions. And the one with the anti-dilutive provisions, here I'll make a reference to a pop culture thing. I don't know if all of you have seen this movie called The Social Network, but that one explains the origin story of the company Facebook since its inception. Most people don't know this, but the Facebook, as it was called back then, was founded by a bunch of people and not just Mark Zuckerberg. And in the Hollywoodized version of the story, it's shown how the co-founder Eduardo Saverin was ousted from his own company exactly because of the anti-dilutive properties of other investors' shares. If you haven't picked up this movie yet, perhaps it would be a good lesson in investment and VC investment in a company, and it would be a good time for you to pick it up and look at it.
Watch out for heavily defensive clauses like liquidation preferences, interest rates on the investment, hurdle rates. Also, watch out on penalties on the next rounds if these rounds are at lower valuations. Essentially, anything that looks more like a loan than an investment. You are approaching a VC because you can't take a loan from a bank. So make sure your term sheet doesn't look like a loan. Another pitfall you need to really look at is whether there is a chance that the fund may sell a good company if they're in a bad shape. So don't just look at your investment. Try to see what other investments they have and how stable are these investments, because you don't want to be in a situation when they bail out on your company just because they don't have enough few exit options. Well, honestly, it's not really about making the most of a term sheet. I would never try to make the most of a term sheet. I think it's mostly about aligning interests, and it's really about making the right bets. What I mean is that the founders definitely know better what are their chances of success compared to the VC, because they're coming from within the company. So they can try to apply something that's called the low cost, high value principle. Essentially trade things that are of low cost to you, but will have a high value to the VC, which also means that you need to understand what the VC wants and keep them interested, keep them in the deal. It's really, I don't think there is a really universal advice, but definitely when you're negotiating, there are always things that are cheaper to you and actually have a large value for the VC. So try to trade such things. Also, I think stay calm. Founders are usually emotional about their babies, but just don't forget it's a business venture. You're trying to have your interests aligned, and maybe you want to change the world, but VCs are there to make some money. So keep it calm, keep it rational, keep it positive. I guess that's it.
I'm personally not the one to be talking about these types of things when it comes to gaming the system, so to say, as I'm just not the right type of character. What my advice here would be is to strive for the most balanced version of a term sheet you can get. And by balanced, I mean balanced for both sides. The company and the investors should be protected from malicious intent from the other side. Think about the dividends you may want to get out of the company as a founder, as some investors are locking out this option for you, and negotiate the levels of independence when it comes to everyday decision making. You really don't want to be calling the management board each time in order for you to purchase some whiteboard markers that are just freshly out in the conference room. Now, do you? I thought so myself. But you would be surprised how many founders find themselves in the same situation because they don't know any better and they fall under such restrictions. That being said, last but definitely not least, in this whole process we're outlining over here with the rest of the people, please get some external help. And by help, I mean actual professionals who have done this before. Hire some trusted consultants, lawyers, financial advisors, etc., to help you out in times like these, as these are the times that your company can really go airy, meaning in the wrong direction.
I'm not much into the tactics, but there are some general rules. First of all, you should have a clear vision of what you want to achieve. Where do you want to go? with this term sheet, how do you think the company is going to develop, what things you should protect for yourself, because now you have your plan A, it's gonna go to plan B, plan C, and whatever. So as you're thinking right now, probably it is not going to go this way. So if you have the clear vision, also when you're negotiating with a VC or with other partners, investors, you should know what they call BATNA, which is best alternative to a negotiated agreement. If this deal doesn't go through, what is your alternative? I have myself seen two different roads to travel. One of them is try to bootstrap, like, guerrilla warfare. You don't have a lot of money, you try to do it with your friends, with your little money, and gradually grow the business. This is in general very tough, especially if you have a market space that you want to enter in a speedy manner. So the other road would be, to capitalize, then do the round B, round C, capitalize more and more, etc., which of course has its own pitfalls, but one should be aware that these two are very distinctive paths. In general, when you're negotiating, I always try to be totally straightforward, no games, no tactics, etc. Yeah, you could employ a lot of things, but in the end of the day, you would lose time. So my strategy is I go there, okay, guys, this is what I want to achieve. Is it working for you? If it's working for you, okay, let's do it. If it's not working, where it could improve. So very straightforward manner and very fast.
Okay, I guess it should be clear by now how important term sheet for a founder can be, and it actually is. If I have to give my high-level recommendation from a VC perspective, that would be, have a clear game plan, look at the term sheet holistically, be aware that you probably have to give up certain items and clauses throughout the process of negotiating. Be aware what you can drop, what you can trade, where actually, that's very important, where your red lines are and where the red lines of the investor are, and be prepared to act kind of quickly. So if I have to summarize, have a game plan, know your red lines, and also be quick in these negotiations, and don't let an item open for a long period of time, because it creates tension, and in the end it can even risk your deal. But these are my recommendations, and I would like to ask Jordan about his. But if you can single out your top recommendation, Jordan, what would it be?
Well, actually, from the top of my mind, I have two recommendations. The first one is kind of I'm stepping on yours there, is just to look at the big picture. Don't concentrate into the nitty gritty. Try to, again, as Sasha said, to look at the term sheet holistically, and just remember that you don't want to waste too much time, take too much time to negotiate the entire term sheet process, because again, it can reach a point of attrition. You don't want to have that. And also remember that the term sheet is just one piece of the puzzle along your journey to fulfill your vision. Know and concentrate on the important things that are important for you, and try to negotiate this. And the second thing I would probably recommend to the founder is to use the time and the process of term sheet negotiation to know better the party that is opposite of you. The term sheet process will enable you to gain very interesting insights into the thinking pattern of the venture capital fund, the way they operate, which could kind of give you some red flags as well, Remember, you want to have a fund that shares your vision, your work ethics. They are helpful. They're not micromanaging as well, and the term sheet negotiation process can kind of show that very, very well, and you can get very insightful perspective there. Again, you're gonna be, let's say, married to these people for 5-10 years, and you don't wanna, spend the most, critical times of decision-making process with people that you don't like and you don't have any chemistry with, or that are doing something that you think is different from adding value to the company.
Yeah, I'm 100% with you here. Absolutely agree. But let's see if the founders, our successful founders, share the same opinion with us here.
In terms of my recommendations to other fellow founders when they negotiate a term sheet, there is a lot of information out there. There are many books that are very interesting. I particularly like two books. One of them is called The Entrepreneurial Bible, Venture Capital. It is written by Andrew Romans, who is a general partner of Rubicon Venture Capital. The other one, I don't have it with me now, but it's called The Secrets of Sand Hill Road, and it is written by Scott Cooper, who is a partner in Anderson Horowitz. It is a more detailed, I would even say to some extent, legal handbook, where you have a lot of terms and the different aspects, and it leads you through the whole process of negotiating a term sheet, a deal. If you are starting a business, if you're negotiating a term sheet, these are good investments. Look at them, and probably you'll find some things that are going to save you a lot of money, time, and hassle over the years. Of course, if you have people who have traveled the same road, talk to them, because again, I will emphasize, when you're doing the first time a startup, you have no clue how things are going to go. But if you have done 2, 3, 4, whatever, then you really understand the process very well, and there are not many surprises. If you have done this thing 2 times, 3 times, everything that comes to you, you would have seen it, or you would know how it goes, how it plays. So talk to people who have done this many times, preferably at least for a couple of years, so they have this 5-year, 10-year exposure to this process, and this is gonna save you a lot of time, money, hassle again.
As a general rule of thumb, I would like you to stop and think really hard before you even start looking for an investor, as there are upsides and downsides to everything in life, as you already know, of course. You've been alive for a number of years now. I know that perhaps here is not the right venue or time to discourage you from taking in outside investors, but you really need to weigh in all of your options before you commit to something. Because once you pull the trigger, there is no turning back. That being said, though, the option you need to weigh is the decision on how fast you would like to move forward. For instance, with us at CloudCard, we were a profitable company on our own, so we could have kept on the way we did business on our own and kept the status quo. But the vision of the founders of the company needs to be taken under consideration as well. For us, we wanted to become the #1 e-commerce SaaS company in Europe. If we were to go on with the current way we did business before, that meant that it would have taken us way more time, perhaps even ×10, and it was not sure a thing that we would be able to do it on the merit of our own software benefits alone. Because in a business, there are a number of different factors in play when it comes to market positioning, and your product is just but one of them. In order for us to be able to move fast and move in the right direction, meaning in new markets, we decided that we needed to onboard not just some investors, but the right investors, ones which we have the same vision with for the future and have a synergetic relationship with. To simplify it, this is called taking in smart money. All of this enables us to move quite faster and way more focused, in a more focused way than ever before, which is a huge upside to dealing with outside investment. And it definitely doesn't hurt that NV3 are such cool dudes, if I may say so myself. So going back to your individual case, my advice here would be, first, weighing your options before committing to anything. Second, then, when you have decided to go forward with the investment route and the term sheet is sitting in front of you, bargain for the most balanced approach to everything written in there. And number three, keep your eyes fully open for the pitfalls which can oust you from your own company, like with the examples I gave on the voting rights and anti-dilutive provisions within that specific term sheet.
I think again, first look for a good chemistry with the VC guys. You're going to be together with them for a few years, and if you don't get along during the negotiation times, it's not very likely you're going to do so well with them in the future. I think also absolutely speak with founders who have had the whole journey with the VC, basically how it went, what kind of troubles did they have, and how the VC reacted when the times were good and times are bad. The last thing is explicitly ask what the VC is going to do for you. Is it just the money? Are they promising network connections? Are they promising you some resources, some experts? And if they are, make sure it's in the agreement, because these things get forgotten. Everybody wants to help, but essentially then new deals come and people get busy. So if they promise you something, just make sure it's on the agreement.
Back again, as you have seen, the negotiation process and the term sheet process could be a bit complicated and very often than not, very often actually, even if you have a term sheet on the table, this doesn't mean that the deal could be finalized. Many deals get derailed even after we have a signed term sheet. There might be different reasons. It could be the valuation, it could be the pricing, it could be management team restructuring, and all these things. Recently, we had one such deal, the potential acquisition of Pinterest by PayPal. What are the reasons behind this deal falling through? We can see in the next video that was prepared by my partner Alex as part of our deep dive mini-series.
Welcome back in Between Two VCs deep dive series. In this series of short videos, we dive into technologies and industries we're excited about, and we are going deep into a recent topic in the tech world. Today, we look into news that broke out late last month that PayPal is in talks to acquire Pinterest for over $40 billion. Well, as of today, it seems this acquisition will not materialize as PayPal backed off from the deal, but we think it's a very interesting development that deserves our attention. First, a short reminder, NV3 Venture Fund is an early stage venture fund with portfolio interest in various tech verticals, including digital payments and e-commerce. And PayPal and Pinterest are market leaders in these fields. Pinterest offers a unique approach to social media that focuses on product discovery and less on social networking. And as such, is uniquely positioned at the intersection of several trends that we believe will be monetized through social networks in the future. And these trends are e-commerce, AR and VR, and digital payments. And if implemented correctly, Pinterest can be the market leaders of social commerce. This is the combination of online shopping with network effects on social media. And this, we believe, was one of the primary reasons for PayPal to even explore such an acquisition in the first place. And PayPal is a provider of online payment systems and related services, and the company processed transactions of close to $1 trillion in 2020, including $160 billion managed by the rapidly growing payment app Venmo. So let's look at what would be the positives of such a deal if it had happened. In theory, PayPal would provide Pinterest with a fully integrated checkout solution and a better in-app shopping experience. And Pinterest has the potential to grow much faster than the existing business of PayPal. It can even double its business over the course of the next few years. Pinterest has more than 450 million active users. So that's more than the user base of PayPal. And I don't know if it's positive or it can actually break up a deal, but Pinterest is already partnering with some of the other e-commerce giants like Shopify. So we know PayPal is not pursuing this acquisition anymore. So let's take a look at what could be the business rationale for PayPal to actually abandon this deal. Well, Pinterest would lose the status of its neutral and unbiased platform. And for PayPal, PayPal already has the two key assets necessary to include commerce in its digital wallet: over 370 million consumers or users and over 30 million merchants in its ecosystem. And even though Pinterest has 450 million active users, we believe there likely is a significant overlap between the two groups of users. So the number of unique users might be much lower than the combined sum of the two. And I don't know if that's a business rationale or not, but the stock market reaction to the leaked news was quite negative. And we don't know if it was a stock-based deal or cash-based deal, but a 10% decrease in the stock price of PayPal can materially affect the purchase price and actually make the deal unsuccessful and reasonable. So here we are a month later, and for me personally, this deal would have made much more sense for Pinterest than for PayPal. But anyhow, the two companies continue to trade on a standalone basis and will continue to do so for foreseeable future. And that's, I think it's very positive for investors, because based on their risk profile, they can get exposure to each of the companies now. I hope that you like this short deep dive. Thank you very much, and stay connected between two VCs.
Okay, we always try to give you our take on important topics, and in this case it was a global topic of interest, our interest, probably your interest, but in many cases, guys, we ask you to pick the topic of interest yourself. On our LinkedIn page, we usually have a short quiz, and this time the most voted answer in this short quiz was the topic of single versus multiple founders. And even though I know how you're going to answer, you're done, but if you're about to select single or multiple founders, what would you select?
Well, multiple founders for sure.
Yeah, definitely. I think that was an easy one. Multiple founders for me is also the answer here. But you know, I heard to say that there are some specifics to it, at least for myself. And as much as I like and I believe that there should be more than one founder in a company, I think that there should be one founder who is leading, and that the responsibilities should be clear at the very beginning, because you not often see two CEOs or two chairmen of a board or something like that. So there should be clear responsibilities, a leading role within the founders team, also aligned interests. That's very important, so that the entire team of founders can put forward together. It's actually a news from yesterday or the day before yesterday. Jack Dorsey, the CEO and founder of Twitter, he announced that he's stepping down as a CEO of Twitter. And in his statement, he mentioned something like that a single founder is point of failure, and there is severe risk for a single founder CEO. Or something like that, but the idea is clear. The risk of a single founder is quite high, and there should be a larger team with broad spread responsibilities. I don't know if you share this view, Jordan.
Yeah, I cannot agree more. Co-founders that complement each other have, in terms of skill set, in terms of split of responsibilities, is the best recipe, and this is the configuration that we're looking for when we invest in a given company, in a project. If you're a single founder, you run the risk of getting to a point of a burnout because you're juggling so many balls in the air, you're playing in different fields and you cannot focus. That is why my recommendation is, whenever you're raising money from a VC, try to find a co-founder if you're a single founder, and thus you will increase your chance of success considerably. I also think that the single founder is a single point of failure, and we do not like to, when we try to evaluate a deal, whether we want to invest in a given company, this is one of the check marks that we have, and we need to kind of to tick before we decide whether to invest in a company.
Yeah, absolutely. So friends, this is everything for today's episode of Between Two VCs, which is actually the last one for this year, because next time we're going to see each other is going to be the beginning of 2022. And in the next episode, I think it's going to be very interesting for you, because we are going to discuss the craft behind VC and startup valuations. And everyone who is preparing a fundraising round, the first fundraising round, or second or third, probably should watch us, because it's going to be quite useful for them. Till then, stay connected with us on our LinkedIn page, where we share different news about our portfolio companies and interesting topics from the tech world and VC and startup world. Thank you, and see you soon.
Thank you.